The barrier is finally gone. For months, the global financial world kept repeating the same story, that $65 was the absolute ceiling, the final line in the sand. Banks were supposed to defend it with endless paper contracts, no matter the cost. But the market had its own plan. On Friday, the 19th of December, the vote was cast and the result was loud and unmistakable. We did not simply test 65. We tore straight through it. Within hours, silver surged with force, racing as high as $66.50 before pausing slightly near $65.80. That brief pause is what caught everyone's attention, and for many, it triggered a familiar unease. Right now, a lot of people are staring at that pullback, watching the price slide from the highs, and doubt is quietly settling in. The same questions surface every time. Was that the top? Was this just another fake breakout designed to trap buyers? This is the moment where perspective matters most. What we are seeing is not weakness, not failure, and certainly not a collapse. It is one of the most powerful technical behaviors a market can show. It is a retest. Markets do not move in straight lines forever. They breathe, they test, and they confirm. This pause is the market checking whether the ground beneath it is strong enough to support the next move. To understand why this breakout happened so fast, you have to look beneath the surface, deep into the plumbing of the market where derivatives quietly shape price action. The sudden jump from the mid-60s was not fueled by emotion alone. It was mechanical. It was forced. Options traders use a concept called gamma, a measure of how quickly risk changes for the institutions that make markets. Imagine the banks as the house in a casino, confident and comfortable while prices stayed below 65. They'd sold massive call options at that level, baits that silver would never cross it. As long as price stayed under the line, those baits expired worthless and the house kept collecting. But the instant silver crossed 65, the rules flipped. Losses did not rise slowly. They exploded. As price pushed higher, the computers managing risk inside those banks went into defense mode. When silver moved beyond 65.10, alarms were triggered. To prevent catastrophic losses, those systems automatically began buying silver futures, not out of belief, not out of optimism, but out of necessity. That buying pressure pushed prices even higher, which increased risk further, forcing more buying. This self-feeding loop is known as a gamma squeeze, and once it starts, it feeds on itself. That is how silver seemed to teleport higher in such a short window. And now, the pullback makes sense. If prices had continued straight up without pause, instability would have followed. By pulling back and testing the former ceiling, the market is turning resistance into support.
The wall at 65 has already fallen. What matters now is whether the rubble can be held and defended. This quiet moment is not the end of the story. It is the part where the foundation is laid, setting the stage for what comes next in this unfolding market narrative. It is the exact same mechanism that sent GameStop soaring to $400 back in 2021. Nothing about this is tied to fundamentals. Nothing about it is supply and demand. It is pure mathematics in motion. And this Friday, the 19th of December, that math was enough to shake the banks to their core. The spike to 66.50 was not random, it was the sound of algorithms panicking, frantically buying to cover exposure. There were no sellers in that moment, only desperate machines executing orders, pushing prices higher in a vacuum. So, why did it stop? Why did silver retreat to 65.80? Humans finally stepped onto the stage. Traders saw the vertical surge, pocketed profits, and allowed the gamma buying to exhaust itself. Reality returned, but the damage was already done. The $65 level had been breached. The psychological ceiling was shattered, and market makers suddenly became wary. They know now that this beast can bleed. Looking at the current price, 65.80, it might appear as a small retreat from 66.50 to the casual observer. But to professionals, it is a confirmation. In technical analysis, there is a golden rule. Old resistance becomes new support. For months, 65 had acted as a roof. Every approach ended in rejection. Today, we smashed through that roof. Now, we stand on top, testing the new floor. This pullback is the market's way of checking if the foundation holds. Buyers need to step in and assert themselves. If we can hold above 65 for the rest of the day, it signals a genuine breakout. The narrative flips. 65 is no longer a level to sell at, it is a level to buy at. Yet caution is necessary. If silver slips back below 65 and closes the day at 64, it would be a classic fakeout. That would indicate the breakout failed, sellers are still in control, and a sharp crash could follow. For now, 65.80 is a battleground, a buffer zone with 80 cents of breathing room above danger. Celebration is premature. And what about the whale, the mysterious bear who absorbed $650 million worth of silver at 63? Many wondered if they sold at 66.50, dumping on retail investors. Watching the order book this morning tells a different story. When silver fell from 66.50 to 65.80, massive block orders appeared on the bid side. Someone stepped in at 65.75 and said, "I will take it." This reveals something crucial. The whale is still here, quietly defending the market, proving that the new floor is not just theoretical, it is being actively tested and supported. The story of this breakout is far from over. The smart money sees 65 as cheap. Just last week, 63 felt like a bargain. Now, they are stepping in at higher levels, defending the breakout. This is not the behavior of a casual speculator eager to cash out. Speculators sell into strength, chasing quick profits. This bear, however, is supporting weakness, laying a foundation under the market to prevent it from collapsing back below 65. Why? Because they understand what comes next. They know that if 65 holds, the next target is not 66. It is 70, then 85. They are establishing a base camp, securing territory before the next advance. So, when you see 65.80 on your screen, don't interpret it as a setback. See it as consolidation. See it as the big players reloading, preparing for the next leg. The gamma squeeze was the spark. The retest is the fuel. But the real fire comes from the short sellers. Commercial banks, the likes of J.P. Morgan and Bank of America, have been short silver for years, selling paper contracts to suppress the price. But when silver hit 66.50, their positions turned catastrophic. In Part 2, we will dive into the capitulation of the banks. We'll explore the rumors of a major commercial bank closing its short position this morning and break down exactly why short covering acts like rocket fuel for the price. We'll calculate how much money these banks lost in just 4 hours. The breakout has occurred. Now comes the cover panic. If you're just joining, let's reset. Silver shattered the $65 ceiling, surged to 66.50, and is now consolidating around 65.80. The gamma squeeze, the algorithmic buying frenzy, was the spark, but a spark alone doesn't burn a forest. In the silver market, the fuel is the commercial short seller. For decades, bullion banks have played a profitable game: sell paper when prices are high, buy back when prices are low, acting as the governor on the engine, keeping speed limits at $30 or $50. But today, the governor broke. Crossing 65 flipped the math from profitable to catastrophic. Rumors persistent, though unconfirmed, suggest that a major U.S. commercial bank began liquidating its short position this morning. In Part 2, we will dissect that capitulation and do the math to reveal exactly how much the banking cartel lost when silver hit 66.50. The story is far from over, and the next chapter promises fireworks. We are about to reveal why a bank covering a short position is perhaps the most bullish force in any market. And we'll explain why this particular level 65.80 is the pain threshold that could trigger systemic margin calls. The banks aren't fighting us anymore, they are fighting for their own survival. To understand the panic unfolding in New York, we need to look at the commitment of traders. Report a weekly snapshot showing who is long, who is short, and who is trapped. Commercials, a coded term for the bullion banks, have historically been net short. That means they have sold far more paper silver than they actually own. According to the latest data, their net short position stands at roughly 80,000 contracts. Each contract represents 5,000 ounces. Do the math. 80,000 times 5,000 equals 400 million ounces. 400 million ounces of silver that they have promised to deliver but do not actually own. They sold it on paper hoping to buy it back cheaper at 50, at 55. Today, the price sits at 65.80. Every single contract is now underwater. This is a trap the size of a mountain. When you are long, the worst-case scenario is that the price drops to zero. When you are short, the risk is unlimited. If silver jumps to $100 or $500, the banks owe that money. There is no ceiling. At 66.50, the risk managers woke up and saw the exposure, empty vaults, and realized that potential losses could surpass their quarterly earnings. This forced a dramatic change in behavior. Normally, when silver rises, the banks add more shorts to cap the price. But today, their credit lines are maxed. They cannot add more shorts, they can only close them. And how do you close a short? You buy. You become a forced beer. Suddenly, you are competing with Tesla, with the whale, with retail investors. Price no longer matters. You just need out? This creates a massive bid under the market, a trampoline that catches every dip. Every time silver pulls back, a bank steps in to cover thousands of contracts. That is why 65.80 is holding steady. The banks are, in essence, eating their own tail, providing the support that prevents a collapse. Let's quantify the pain because markets are driven by pain. And right now, it is concentrated in the boardrooms of Wall Street. For every single dollar that silver rises, the commercial short position loses roughly $400 million. Since the breakout began at 60, silver has risen almost $6. Multiply 6 by 400 million and you get $2.4 billion. $2.4 billion lost in just hours, and the market is still climbing. The story is unfolding, and the force behind it is bigger than most investors can imagine. That $2.4 billion in paper losses is just the beginning. On its own, it's a disaster, but reality is far harsher. That figure assumes the banks could cover their positions at the current price. They cannot. If they tried to buy back for 100 million ounces right now, the price wouldn't linger at 65, it would rocket toward 100 instantly. This is slippage. The act of exiting a trade makes the trade far more expensive than anticipated. So the real losses could easily escalate to 10 billion or even 20 billion. It becomes a black hole on the balance sheet. This is why 65 was the Magno line. Above it, losses become visible to shareholders. Above it, bank CEOs start receiving calls from regulators questioning solvency. We are watching a slow-motion car crash. The banks are attempting to exit gracefully, to cover their shorts quietly without triggering a price spike. But the whale we discussed earlier isn't letting them. The whale is absorbing every ounce the banks try to sell, forcing them to bid higher. This is the essence of a short squeeze. It's not just price rising, it's a massive transfer of wealth from the entities that suppressed silver for decades to those who now hold it. Every dollar the price climbs represents $400 million flowing from Wall Street to Main Street. How do we know the banks are truly capitulating? How do we know they aren't merely reloading for another attempt to crush the market? The key is open interest, the total number of active contracts. In a normal market, rising prices usually coincide with rising open interest. In a short squeeze, the opposite happens, price rises while open interest falls. Shorts are closing their positions and leaving the market, taking their ball and going home. Later today, when preliminary data for Friday the 19th of December is released, that number will tell the story. If silver holds at 65.80 and open interest has dropped significantly, that is the smoking gun. It confirms the rally was fueled by banks exiting. It is the most bullish signal imaginable. The permanent sellers are gone. With shorts closed, selling pressure evaporates and the price is free to reach its natural level. Yet a warning is necessary. Banks are wounded animals. Before fully capitulating, they may attempt one last desperate move, a Hail Mary, dumping massive paper contracts in the middle of the night to trigger panic selling. If we see a sudden drop to 64, do not mistake it for the end of the rally. It is merely the death throes of the short seller, a final gasp before the market moves on without them. Assume this is their final attempt to create liquidity so they can exit. Unless silver breaks below 61.50, the trend remains intact. Capitulation is a process, not a single event. The banks are trapped in a paper nightmare. They are hemorrhaging billions, trying to cover their shorts, but while they wrestle with contracts and algorithms, the real world, the physical market, is running out of time. The spike to 66.50 wasn't just gamma or short covering. It was driven by desperation, real, industrial desperation. In Part 3, we leave Wall Street and turn to Main Street. We'll examine the growing disconnect between paper silver and the physical market. Reports indicate major industrial users are now paying $70 per ounce just to secure metal. Dealer premiums are climbing, even as the spot price consolidates. The paper market is broken. The physical market is taking over. If you're only watching the ticker on CNBC, you are missing the real story. You see silver at 65.80, the red and green candles flickering, and assume that represents the value of silver. It does not. That number reflects only a paper promise to deliver silver in New York next month. Step into the real world, pick up the phone, call a refiner, or try to buy a monster box of Eagles, and an entirely different reality emerges. In Part 3, we'll expose the massive gap between the spot price and the street price. While banks struggle to keep paper silver under 66, major industrial players are quietly paying 70 or more just to secure immediate delivery. This is the shadow price. It's the price Samsung pays to keep factories running, the price the US Mint pays for blanks, and in the long run, it's the only price that truly matters. The paper market is a distorted mirror. The physical market is the object. Right now, the object is moving far faster than the reflection. Why would an industrial company pay 70 when the screen shows 65.80? The answer is reliability. Imagine running a solar panel assembly line costing $1 million an hour to operate. If silver paste runs out, the line stops and millions vanish. You call your supplier. They offer two options: wait 3 weeks for silver at the COMEX price of 65.80 or pay 70 and get immediate delivery from their emergency reserve. What would you do? You pay 70. Because in the real world, time is money and certainty is priceless. You pay the premium because the cost of the metal itself is nothing compared to the cost of halting a factory. Reports are pouring in that this premium-driven buying is exploding across the supply chain. Electronics manufacturers are bypassing exchanges entirely. They're going straight to the mines, straight to the refiners, offering cash bonuses just to jump the line. This creates a shadow market. The volume is leaving the exchange, invisible to the charts and the spot price, but physical inventory is being drained at a shocking rate while the banks trade paper back and forth to manage the numbers. The real silver is being vacuumed up by industry at much higher prices. Eventually, this disconnect cannot hold. When the exchanges run out of metal to deliver, the spot price will have to jump to meet the shadow price. That is the moment you see silver leap $5 in a single morning. We are living in that gap right now. The screen lies, the invoice tells the truth. Now, consider the retail market, the place where you and I buy. Check any major online dealer. Look at the premiums. Normally, when the spot price rises quickly, premiums compress. Dealers want to move inventory. Today, the opposite is happening. Spot is up, and premiums are up. Why? Dealers fear they cannot restock. A coin sold yesterday at 63 now costs 65 to replace. They're bleeding capital, so they widen the spread, adding $10 premiums, making the ask price 75. They discourage casual buyers unless desperate, or switch to pre-orders with ships in for weeks. That means they don't have the silver. You're effectively giving them an interest-free loan, hoping they can source the metal later. This is a dangerous game. If silver jumps to 80 in the next 2 weeks, a dealer may default on your order, refunding your 65 and saying, "Sorry, we couldn't source the metal." Your cash returns, but you missed the move. This inventory squeeze at the retail level is the canary in the coal mine. When dealers stop selling, wholesalers stop selling. When wholesalers stop selling, refiners stop selling. The entire chain seizes up. So, if you see 65.80 on the screen, do not assume you can buy silver for that price. The entry point for physical ownership is effectively $75 to $80 right now. The discount window is painted shut, and that brings us to the ultimate risk force measure. We've talked about industrial buyers paying $70, dealers charging $80, but what about the paper holders, the ETF investors, the unallocated account holders? They're sitting on contracts that promise delivery of silver. Almost every one of these contracts contains a clause: if the metal cannot be delivered due to market disruption, the issuer reserves the right to settle in cash. And we are dangerously close to triggering it. If the shadow price is 70 but the spot is 65, the banks would rather hand you 65 in cash than go out and buy $70 silver to fulfill their obligations. It's cheaper to default than to meet the delivery. Once a wave of cash settlements begins, it is game over for the paper market. Trust evaporates. Investors will take that cash and rush into the physical market, driving premiums even higher. This is the feedback loop of doom for the fiat pricing model. Shortage drives premiums, premiums trigger cash settlement sparks physical panic buying, and panic buying pushes premiums even higher. We are in the early stages of this cycle right now. The 65 breakout was the signal. The inability to source metal at that price is the confirmation. Holding paper now is a bet that the system holds together. Holding physical silver is a bet that the system breaks. Look at the spreads today. The system is already cracking. We have the technicals, the bank losses, the physical disconnect. The math is on our side. The geology is on our side. The industry is on our side. But there is one enemy left: the mind of the investor. Fear, hesitation, doubt. They can undo all the advantages if you let them dictate your decisions. The system may be breaking, but only those who understand the story and act decisively will be ready for what comes next.
The next few days will be a psychological torture test. Volatility will spike. Headlines will scream. The banks will attempt one final shakeout before silver begins its march toward triple digits. In Part 4, the conclusion of this series, I will give you the mental armor to survive the storm. I will outline the price targets for the week and provide a strategy to ensure you don't sell your winning lottery ticket for the price of a coffee. The wall is down. The open field stretches ahead. Don't trip at the finish line. We have reached the final chapter of this market alert. We've dissected the breakout mechanics, tallied the billions in bank losses, and exposed the secret $70 shadow price industry is paying right now. But now, it's time to zoom out. It's easy to get lost in the minute-by-minute skirmish, staring at 65.80 and worrying if it holds for the next 10 minutes. But if you do, you miss history in the making. Friday, 19 December 2025, marks the end of an era. The era of cheap silver is over. The era of managed prices is gone. We have entered the era of price discovery. This is both terrifying and exhilarating. In price discovery, there are no maps, no familiar resistance levels. We are trading at prices unseen for a generation, balancing a massive physical deficit against exponential monetary expansion. And let me tell you, the price is not 65. It is not 70. It will be multiples of where we are today. In this final breakdown, I will give you the psychological tools to survive the next leg of this journey. I will show why 65 is actually cheap when adjusted for inflation, and leave you with the strategy to ensure you hold your winning ticket. The biggest enemy you face isn't JP Morgan or the banks. It is vertigo. When an asset moves this fast, breaking all-time highs and entering blue sky territory, the human mind reels. You look at your portfolio and see gains that used to take years happen in days. Your brain screams, this can't be real. It must crash. Take the money and run. The banks know this. They count on it. Retail investors become weak hands not because they lack money, but because they lack conviction. In the coming days, expect volatility designed to induce motion sickness. Silver could drop $3 in an hour and then surge 5 the next. It's a trial by fire. Only those with conviction, patience, and a clear plan will navigate it successfully. The wall is down. The open road is ahead. The party has just begun, and the journey into price discovery is only getting started.
They want you to get so rattled by the swings that you sell just to sleep at night. Do not give them that satisfaction. Volatility is the price of admission to generational wealth. If you sell now at 65.80, where do you go? Back to the dollar, losing roughly 5% of its value a year. Back to the stock market, trading at historic valuations. You have to realize silver isn't just rising, the dollar is falling. Silver is the mirror reflecting the collapse of the fiat currency system. Do not sell the lifeboat to buy a ticket back onto the Titanic. Turn off the screen. Stop obsessing over the 1-minute chart. Look at the weekly chart. Look at the monthly chart. The trend is vertical. The momentum is unstoppable. Let the market do the work for you. And yet, I hear it all the time, 65 is too high. People compare it to silver at 20 a few years ago and panic. Let's look at history and the math. In 1980, the Hunt brothers squeezed silver to $50 an ounce, the all-time high. But $1 in 1980 was worth far more than $1 in 2025. Adjusted for official CPI inflation, that $50 high is roughly equivalent to $170 today. Think about that? To simply match the purchasing power of the 1980 high, silver needs to nearly triple from here. At 65, silver is trading at roughly a 60% discount to its inflation-adjusted high. It is the only major asset class anywhere in the world trading this cheaply. Stocks are at all-time highs. Real estate is at all-time highs. Art is at all-time highs. Silver is still clawing its way out of a 40-year bear market. When you feel like 65 is too high, remember, you are buying the most undervalued asset in human history. We are not at the top. We are barely off the bottom. This perspective is your shield. When the media screams bubble, you look at the inflation math and smile. The bubble isn't silver. The bubble is the dollar. That brings us to the final question. When do you sell? If silver is headed to 100 or even 170, when do you cash out? Here's the secret of the wealthy. You never sell for cash. Cash is a melting ice cube. You only sell to swap trading an overvalued asset for one that is undervalued. That is how wealth compounds. That is how fortunes are preserved and grown. The game isn't timing the top, it's knowing the right exchange. Right now, silver is undervalued. Eventually, at $100 or $200, it might become overvalued relative to other assets. Watch the gold to silver ratio. It is your roadmap for when to swap. Today, it takes roughly 70 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 40 to 50 to 1. In 1980, it dropped as low as 17 to 1. If the ratio falls to 30 to 1, that is your signal. Swap your volatile silver for stable gold. You effectively double your gold stack for free without ever touching a dollar. Or swap for real estate. In 1980, a median home in America cost roughly 800 ounces of silver. Today, at 65, you need about 6,000 ounces to buy the same home. Wait for that ratio to close. When you can trade a monster box of silver for a down payment on a farm, that is the exit. Don't trade for numbers on a screen, trade for acres, for ounces of gold, for cash flow. That is how you lock in a true wealth transfer. We have covered a lot today: the breakout, the gamma squeeze, the bank losses, the physical disconnect, and now the psychology. Friday the 19th of December 2025 will be remembered as a tipping point, the day the banks lost control, the day the $65 wall fell, the day the genie came out of the bottle. You cannot put the toothpaste back in the tube. The world now knows silver is scarce. They know the price was suppressed, and they are rushing to get a seat at the table. You are already seated. You saw this coming while everyone else was asleep. Now your task is simple. Do not move. Do not sell. Let the market come to you. The squeeze has just begun. Hold fast. Stay disciplined. The opportunity is monumental, and fortune favors those who remain patient and unwavering. The journey is only starting.
The next few days will test your nerves like never before. Volatility will surge. Headlines will grow ominous. The banks will attempt one last shakeout before silver begins its march toward triple-digit territory. In part 4, the conclusion of this series, I'm going to equip you with mental armor. I'll show you how to navigate the volatility, outline realistic price targets for the week, and provide a strategy to ensure you don't sell your winning lottery ticket for the price of a coffee. The wall is down. The field is open. Don't stumble at the finish line. We have reached the final chapter of this market alert. We've analyzed the breakout mechanics, counted billions in bank losses, and exposed the secret $70 shadow price that industry is paying today. Now it's time to zoom out. It's easy to get lost in the minute-by-minute swings, staring at 65.80 and questioning whether it will hold for the next 10 minutes. But if you do, you miss the bigger picture. Friday, 19 December 2025, marks the end of an era. The era of cheap silver is over, and the era of managed prices is officially dead. We have entered the era of price discovery. This is both exhilarating and intimidating. In price discovery, there are no maps. There are no resistance levels because we are operating at prices unseen for a generation. The market is searching for the level that balances a massive physical deficit against an exponential monetary expansion. And make no mistake, the price is not 65, it is not 70, it is multiples of where we are today. In this final breakdown, I will give you the psychological tools to survive the next leg of this journey. I'll show why 65 is actually cheap when adjusted for inflation and leave you with the strategy to ensure you hold your winning ticket. Just as the party begins, the wall is down and the open road stretches ahead. The biggest enemy you face right now is not JP Morgan, it is vertigo. When an asset moves this fast, breaking all-time highs and entering blue sky territory, human instincts rebel. You look at your portfolio and see gains that used to take years to achieve happening in days. Your brain screams, this can't be real. It must crash. Take the money and run. The banks know this. They rely on it. Retail investors become weak hands not because they lack capital, but because they lack conviction. In the coming days, expect volatility engineered to shake your resolve. Silver could drop $3 in an hour, then surge 5 the next. This is intentional, designed to induce motion sickness and test your discipline. But remember, this is the price of admission to generational wealth. They want you to panic. They want you to get so rattled by the swings that you sell just to sleep at night. Do not give them that satisfaction. Volatility is the price of admission for generational wealth. If you sell now at 65.80, where do you go? Back to the dollar, the currency losing 5% of its value each year. Back to the stock market, trading at historic highs. You need to understand, silver isn't just rising. The dollar is falling. Silver is the mirror reflecting the collapse of the fiat currency system. Do not sell the lifeboat to buy a ticket back onto the Titanic. Turn off the screen. Stop obsessing over the 1-minute chart. Look at the weekly chart. Look at the monthly chart. The trend is vertical. The momentum is unstoppable. Let the market do the work for you. And yes, I hear it all the time, 65 is expensive. People compare it to silver at 20 a few years ago and panic. But let's look at the facts. In 1980, the Hunt brothers squeezed silver to $50 an ounce, the all-time high. But $1 in 1980 was worth far more than $1 in 2025. Adjusted for official CPI inflation, that $50 high is roughly equivalent to $170 today. Think about that. To simply match the purchasing power of the 1980 high, silver needs to nearly triple from here. At 65, silver is trading at a 60% discount to its inflation-adjusted high. It is the only major asset class on the planet trading this cheaply. Stocks are at all-time highs. Real estate is at all-time highs. Art is at all-time highs. Silver is still recovering from a 40-year bear market. When you feel like 65 is too high, remember this: you are buying the most undervalued asset in human history. We are not at the top, we are barely off the bottom. Let this perspective be your shield. When the media screams bubble, look at the inflation math and smile. The bubble isn't silver. The bubble is the dollar. And that brings us to the ultimate question: when do you sell? If silver is headed to 100 or even 170, at what point do you cash out? Here's the secret of the wealthy: you never sell for cash. Cash is a melting ice cube. You only sell to swap trading an overvalued asset for an undervalued one. That is how wealth is preserved. That is how fortunes grow.
Right now, silver is undervalued. Eventually, at $100 or even $200, it may become overvalued relative to other assets. Watch the gold to silver ratio. It is your roadmap. Today, it takes roughly 70 ounces of silver to buy 1 ounce of gold. Historically, that ratio averages around 40 to 50 to 1. In 1980, it dropped as low as 17 to 1. If the ratio falls to 30 to 1, that is your signal. Swap your volatile silver for stable gold. You effectively double your gold stack for free without ever touching a dollar. Or swap for real estate. In 1980, a median home in America cost roughly 800 ounces of silver. Today, at 65, you need about 6,000 ounces to buy the same home. Wait for that ratio to close. When you can trade a monster box of silver for a down payment on a farm, that is your exit. Do not trade for numbers on a screen. Trade for acres. Trade for ounces of gold. Trade for cash flow. That is how you lock in the wealth transfer. We have covered a lot of ground today: the breakout, the gamma squeeze, the bank losses, the physical disconnect, and now the psychology. Friday the 19th of December 2025 will be remembered as the tipping point, the day the banks lost control, the day the $65 wall fell, the day the genie came out of the bottle. You cannot put the toothpaste back in the tube. The world now knows silver is scarce. They know the price was suppressed, and they are rushing to get a seat at the table. You are already seated. You saw this coming while everyone else was asleep. Now your job is simple. Do not move. Do not sell. Let the market come to you. The squeeze has only just begun. Hold fast. Stay disciplined. The journey has started, and fortune favors those who remain patient and unwavering.